you for joining us today for our lunch presentation. We always are looking to keep you informed and up to date, but also share best practices with you. So today's topic is navigating M&A success, market trends, and transaction success. So hopefully you are in the right spot, and this was the webinar you thought you signed up for. So I'm just going to kind of go over a couple things with you. Today's presentation, we will explore the market trends in the business acquisition and sales. We'll talk about what we're seeing nationally and then also locally, and then our experts will get into some recent transaction stories, what made them successful, what bumps in the road they hit, so that you can learn from that and have a smooth one yourself. I'm Carolyn Powell. I'm the Development Director here at Tronconi Seguin Associates. I'll do a quick little housekeeping with you. If you've been on our webinars before, you kind of know how this works, but there is a toolbar on the right-hand side of your screen. And in there, you will find the handouts of today's presentation and a copy of the bios of our experts, if you want to grab those. There is also a question section throughout the presentation. Please just put your question in there. We will answer it throughout the presentation and definitely at the end. At the end of today's session, there will be an exit survey that you will immediately receive. If you could please fill that out, let us know if you want to set up a time to talk with any of our experts. If you have any additional questions, what topics you would like to see in the future, and how the session was today. This afternoon, I will send you an email with a copy of the presentation again, but also a link to the recorded session. That way, if you want to go back and re-listen to something or share it with a colleague, you can do that with the email I'll send this afternoon. So I think that is it for my housekeeping, just checking my notes. So let me introduce all the experts as they come on camera now. So Mark Ferm is a CPA and partner here at the firm. He has over 25 years experience in public accounting, broad range of expertise. Well, first off, he heads up our M&A transaction advisory services here at the firm, both on the sell side, buy side, and due diligence. Multinational companies he works with, local companies, doing audits, forensic accounting, fraud services, and so much more. Pat Sullivan is with us also. He is a CPA and has over 9 years in public accounting and private industry. Broad range of experience there also with business valuations, due diligence for M&A projects, financial modeling and analysis, and more. And Josh Thompson is also with us today with over 6 years experience in public accounting. And again, that broad range of experience to be able to help you with business valuations, due diligence for M&A projects, financial modeling and analysis, and quality earnings reports. So before I hand it over to the guys, I want to get a little bit more information on you so they can adjust the presentation. We're going to do a quick poll. Get it up here for you. So the question is, what are you looking to learn today? A couple different things as you all take a quick look at it. Are you on the sell side, buy side, both sides, just learning? Let's see when you come in. Right, we have a broad range here, so I'm going to close it out in just a minute. All right, experts, let's share the results so we can see who you're talking to. All right, buy side, both sides, learning. So a couple people just curious. So that's who your audience is today and who you'll be talking with. Thank you, everybody, for doing that. And then I have one more question for everybody. What stage of the M&A process are you currently in? I'll get that on the screen. All right, experts, where do you think we're going to come in on this one?
I'm gonna say looking for an opportunity or have done a deal recently in the past.
Okay,
I'm gonna say looking for an opportunity in the next 6 to 9 months.
Yeah, I would say the same.
right, give them, everybody just a minute to put their thoughts in here. Again, we got somebody in every category. We're going to close this. I'll just share it real quick so you can again see where our grouping is. Got some people that are just curious, so maybe we can get some information to them, make them feel a little bit more comfortable in taking the next step, and everything else in between. So I don't want to hold things up any longer. Now that our experts know who you are a little bit more, I'm going to hand it over to Mark to get us started.
Great, thanks, Carol. And I'd also like to thank Josh and Pat, my co-presenters today. We work quite a bit together, and it's a pleasure to have you both here, and Carolyn as well for helping us put this together. And we have a great group also joining us, listening in today, and welcome, both here in the U.S. and we've also seen a lot of our fellow Canadian neighbors that are also joining us too, so welcome. And so what I want to try to do today, and this will be hopefully the first of many more updates we're going to provide. We're probably going to try to do it maybe 3 times a year, give a little bit of update, what we see, just general industry update, what's going on in the M&A market, as well as private equity. And today we add a little bit more to that, and we may do in future webcasts, is what is going on in Buffalo or Western New York to kind of bring that home. And then lastly, we're going to talk through each of these. We're going to try to pick a topic that's relevant to M&A and transactions. And today that is the deal process, some of the challenges that we see in getting a deal done, and the strategies that we see, best practices that we see to try to meet those challenges. So I guess without further ado, I will pass it over to Pat to start with our market update.
Awesome. Yeah, thanks, Mark. So like Mark said, I think with this recurring, hopefully webinar type of format that we have, I think the next few slides, what I really want to touch on, it's going to be more general. So what I mean by that is it's going to encompass all transaction sizes, all industries, but what I'm going to try to do is highlight some key concepts, trends, and obviously, as you can see here from the first slide, the 2025 market outlook as a whole, and then kind of get into specifically M&A transaction trends and private equity specifically. So the hope, I think the ultimate goal is really going to be understanding what's happening as a whole in the space, but then trying to find what key aspects of or key talking points that I bring up that specifically relate to you and how it might apply in your specific situation. So without further ado, we can jump right in. And as I mentioned, the first slide we're going to get into is the 2025 market outlook. So what I did here is I tried to do basically a little bit of a comparison because things have changed quite a bit within the past 4 to 5 months. So on the left-hand side, you can see the outlook as of late 2024, early 2025. So I think the very noticeable difference here was the first point of market optimism. There was a huge rebound in optimism as evidenced by the Citizens Bank survey. Sentiment was at actually a 5-year high. And at the little picture down at the bottom there, some of the driving factors of what was causing this optimism were largely fueled by the confidence from expectations of continued economic expansion, easing of inflation, the new administration coming in who were hoping to be less scrutinized on the regulation front, and then what we saw in the back half of 2024 where the Federal Reserve was starting to ease and cut rates a little bit. So a lot of this was driving, like I said, a lot of optimism, and the hope was, which leads into the next point, it would close this valuation gap that we've been experiencing from, I'd say, 2022 almost through 2024. So what's going on here is, a lot of the hope and, the easing of inflation, which would in turn cause rates to be cut, the economic expansion, it would cause basically debt becomes cheaper, right? So you'd be able to finance a deal, finance certain things at a cheaper rate, which would basically enhance the buyer power, and in turn, it would actually increase your valuation. So that's the first aspect of it. The second was looking at it from a private equity standpoint alone, and this $1 trillion, they have about 1 trillion, if not more, within just the US private equity firms of dry powder, basically cash that's sitting on the sidelines that they're waiting to put in use. So because there's been this valuation gap the past few years, buyers and sellers haven't been seeing eye to eye. So the hope was, with all of these macroeconomic impacts kind of hopefully changing in the near future, cash sitting on the sidelines, they'd be able to deploy that and kind of meet in the middle. And then further beyond the private equity aspect is the corporate-led buyers. So again, since COVID, the bottom lines of a lot of public, private corporations, they have been growing. So they've had healthy balance sheets, a lot of cash reserves sitting on the side that they're also looking to put into play. So that's just another aspect that was really hoping to close that gap. And then the last point here, economic uncertainty kind of begins to reside. So looking at it from the macro side of things, like I said before, inflation was starting to cool. I think like I stated here, the Congressional Budgetary Office was projecting CPI so the Consumer Price Index, or a measure of inflation, to remain below 2.5%. So that, coupled with the expected interest rates that we all hoped would be continuing, these were just kind of contributing to a more favorable deal-making environment at the end of the day. So as we shift to now the right side of the slide, the current state, the biggest thing that has changed is the administration's proposed broad-based tariffs. So what that did is, as everyone was getting more comfortable with the interest rate environment, the economic standpoint as we had before, we throw this wrench into it. And, I think the easiest way to view that is, in the eyes of the investor, it creates a lot of murkiness. And I think if you looked at the stock market in March, that's where it's visibly apparent. Granted, everything bounced back, but again, it just goes to, it's a prime example of, when something like this happens, it throws a little bit of gray area. It opens investors or potential investors' eyes into, what their risk tolerance is and, how much they're willing to take on in order to make a deal happen. So,
Yeah, I'd probably say, Pat, this is probably by far the most common question we get from clients that may not even be in the transaction mode, but certainly in the transaction mode, is how does this uncertainty impact valuation, timing, the risks that there. So I think that, and which we'll talk about later, the tariff impact definitely has some noticeable impact on the Western New York market.
Right. Yep. And then just the last point here, steady interest rates. We talked about it. Back half of 24, the Fed started cutting them. Right now they're sitting between 4.25 and 4.5%. But I think throughout 25, they've obviously kept them steady. And as of last week, they held them steady, and they even indicated that, they've actually adjusted the expected expansion of GDP down, and they also adjusted core inflation up. So both negative impacts to their outlook. So it kind of gives you a sense of where the Fed is currently sitting on these instances. All right, we can go to the next slide. Perfect. Okay, so now specifically jumping into the M&A landscape. So what we did here is we tried to drill in particularly to North America. So for the first bullet point there, Q1 2025 deal volume trends. There's a slight dip from the prior quarter, really not much. For context, there was about 4,900 deals that were closed in Q1 of 2025. And then there was 5,000 in Q4 2024. So really not much of a dip. And I do think that it makes sense based on everything we talked about. There's a ton of optimism kind of heading into the year and post-election. So that kind of really started to gain some momentum. And year over year was an even stronger growth of about 20%. So as I stated, there was a ton of early momentum. It was largely driven by all of the considerations that I had mentioned previously. You know, the new administration coming in, the really normalization of the economic environment. So like I said, inflation, interest rates, all those things starting to subside and come back into line. So it helped instill a little bit of confidence in everyone in the deal-making environment. However, as you can see, mid-quarter shift, there's a big shift in sentiment. And as I kind of alluded to, it was more apparent, I think you could easily see it in the stock market, but it was also similar in the M&A space as well. You know, the rising concern of tariffs and what the trickle-down effects are ultimately going to be, that really led to the real possibility of, again, recession maybe coming into play again. So it's a very new concept right now. I think everyone is trying to navigate it and see what the trickle-down effects are going to be. But ultimately, after hearing the administration's approach, it sounds like these tariffs are going to be the ceiling. And number two, they are open to negotiations. So, you know, it did cause enough uncertainty to where, you know, it caused a lot of investors maybe to pull back from what we were expecting / hoping. But, you know, at the end of the day, it seems like these things could turn on the, you know, on the flip of a coin, basically. So it's just kind of a wait and see game to see if it's going to be a short-term impact or more of a long-term impact.
Yeah, it's hard to say. I mean, yet with the new president, you know, it seems like things change weekly, right? And you know, the other thing that we've been talking with clients about, it seems like now for 2 years, is this never-ending recession risk, right? We just haven't quite seen that yet, but you know, it obviously things could change, but you know, we have been talking about it for 2 years. So I think moral of the story is, I think you just have to have a plan that's strategic, a little bit more long-term, so that you can sort of ride out these recessionary risks that we, again, seem to be talking about for several years now.
Yeah, and I mean, I think going back to that point is it's kind of assessing your own situation, being disciplined on if you are heading into a deal or in a deal, and being opportunistic. If there's something that's going to fit your profile and you're willing to take it on, I think it's a case by case type of situation and kind of look at it from that perspective. So, and then the last point there regarding deal value, you can see, so the graph down at the bottom there, the bar chart, the column all the way to the right shows the deal volume. And you can see that it shot up in Q1 of 2025. You know, that was actually, as I kind of stated or caveated at the beginning of the presentation, these are general, this is general reporting basically. So it's encompassing of all transaction sizes, industries. So a lot of that spike in deal value overall is related to some larger cap transactions that occurred. And it just so happened that North America accounted for 8 out of the top 10. So that's where you see the spike in overall deal value. Now jumping over to the right side, so the M&A trends, the valuations there. Really the big thing that I want to highlight here is, it may not look like it, but we're seeing signs of normalization. If you look at this, at basically 2015 to 2025, if we compare the median from 2022 to 2025, we're sitting at a median multiple, EBITDA multiple of about 10.3. If we take the median multiple from 2015 to 2019, we're at 10.2. So taking out the COVID downturn in 2020 and then the really the bump that we experienced in 2021 post-COVID, everything outside of that, looking at from a median perspective, is starting to fall in line. And many analysts actually think that a reset has taken place already. So the hope is, you know, again, we start to close that valuation gap. I think unrealistic expectations that were experienced in 2021 in regards to valuation start to subside a little bit, and that way buyers and sellers ultimately can kind of close that gap and move forward with some deals. So, and then the next couple of points, private equity, we're going to talk a little bit more in depth on the next slide, but you see that spike in 2024 up to 11.5 multiple. That's primarily private equity influence. Corporate led has been remarkably consistent even through the pandemic. I think their low multiple was about 9.1 in 2018 and 2020. Their high multiple was in 2021, like I stated, when everything was kind of booming at 10.1. And right now in 25, the median multiple is actually at 9.5. So they've been remarkably consistent, as I said, over the period, even through the pandemic. And it seems as though private equity is causing the fluctuations maybe in the more recent years due to a lot of dynamic influences that are impacting them specifically. Okay, so then moving on to the private equity side of things. So as you can see, transaction counts in Q1, transaction volume in total declined quarter over quarter about 5%, but year over year it actually increased about 11.8%. So I think what this is indicating, maybe a little bit of cautious optimism, along with some other factors that they're trying to navigate in regards to the valuations and ample dry powder sitting on the sidelines versus the extended holding periods, which we'll get into a little bit more next, that they're experiencing. So it seems like they're involved with a bunch of different pressures that are conflicting against one another. So this is a case-by-case basis, I think, for each PE firm. So in regards to valuations, PE-led purchases, you can see in 2024 and then the TTM period, they are elevated, even 22 elevated compared to the pre-pandemic level. And what basically I think is going on here is it's largely driven by, again, PE being selective. So I think they were going after kind of blue chip, high quality assets to where they were willing to pay a premium for them because they were going to leverage that as almost a platform company and then build off of it from there. So that's where you see maybe where the multiples are a little bit higher than the pre-pandemic level. So now that there's only so many of those companies, there's a general consensus that these multiples or the amounts that they're paying may dip a little bit as more assets or maybe some of those not as high quality assets come to market to where it'll eventually cool and level out. So that's on the PE the buying side of things. So as we go to the next point of exits and holding periods, it actually picked up very much in late 2024. And it was their highest exit performance since 2018, excluding the pandemic of 2021. So really what happened here is, again, as I mentioned, they were scooping up kind of blue chip, high quality assets. They were also doing the same in the exit side of things because they realized that the back half of 24, interest rates started to be cut, inflation started to cool, the economic environment was turning more favorable. So they thought that this would be a good time to start to offload some of their better quality assets, get the return on investment that they had initially sought when they invested in the company, and kind of relieve some of the pressure that they were starting to experience due to the prolonged holding periods. So the prolonged holding periods, typically what we see is, 4 to 6 years, they like to hold on and then they'll spin them off. As of right now, their average is about 7 to 8 years, and the inventory is actually continuing to grow. So just a little fact here is, as of Q1, PE firms are holding about 12,379 portfolio companies. 4,271 have been held for 7 or more years. So that's about 34.5% of those have been held for 7 or more years. So, this is just adding to that pressure of, should we hold on to it until there's more favorable environments where we're going to realize some higher valuations, or really how are we going to navigate this type of thing? So And then the next bullet point, economic uncertainty equals opportunity. This is just kind of my take on it. It'll be interesting to see how it plays out because this PE, there may be an opportunity for them to potentially buy low, use some of that maybe dry powder that's sitting on the sidelines. But at the same time, they may have to take a hit on the exits. They don't want to keep holding on to assets or not realize those investments because if you think about that logically, if they're buying low, chances are they're going to be selling low as well. So it'll be interesting to see how they navigate that. And then on the sell side of things is for business owners and everything, I'm curious to see if PE firms do take this approach and they do try to offload some of that capital and buy low, or get in, or maybe find some of those blue chip high quality assets. Are they still willing to pay that premium? So if your company is marketed well, you're very strong financially, you have a lot of intangible value that you can bring to the table, there may be some opportunity there of kind of leveraging that and achieving maybe a higher multiple, which you can see PE hasn't been afraid to pay if it makes sense for them. So, and then the last point, expansion into new service verticals. Just another, interesting fact. We'll see what happens, but they've been getting increasingly into kind of new service-based sectors. We see it with accounting firms, healthcare practices, things of that nature. So, something.
Yeah, pretty unique. I mean, that's even for us, being an accounting firm, Pat, we're seeing a lot of activity in that market space. And another more unique, which we didn't describe here, but one interesting service that actually Josh and I are involved in is pet daycare services. So we have a company that's doing a roll-up of pet, basically doggy daycare, and trying to expand that in a roll-up strategy. So they're getting very creative, and now some states are starting to announce the ability to have non-attorneys own law firms. So you could see potentially, if that were to occur, PE getting involved with law firms, which would be an interesting trend. I think I want to move on and take this, sort of parlay this into, okay, what does this mean for the Buffalo market? What's different? As we all probably know, being from the Western New York, or those that are in Western New York, Buffalo tends to behave differently than the rest of the country, right? Where it seems to always be behind by a year or two in terms of trends. But also we're just different. Our market is different. It tends to be smaller. And some of the metrics that Pat talked about are at a macro level. They include really large transactions. It sort of sometimes blurs the vision for Western New Yorkers in terms of really what's happening in the marketplace. And so I wanted to share some thoughts of what we see with not only our client base, but phone calls that we're taking from all sorts of potential new clients. And so the first being cross-border activity. It's probably been the highest. And I know that Carolyn, the individual who introduced our topic today, she's heavily involved in cross-border. And her and the group that specializes in that, the phone is ringing off the hook. It's probably the highest amount of activity we've had, including on the transaction side. So we have particularly a lot of Canadian companies. We do have a lot of participants from Canada today. We see a lot of them interested in moving into the US. We do know that, the political landscape and some of the things occurring is creating some stress points there, but nonetheless, they see the desire to manage their risk, particularly with tariffs, and opportunities of growing in an environment that is pro-business with less regulation and hopefully soon hopefully lower taxes maybe coming down the road in the summer, is that they see that as a long-term opportunity. So we are seeing a lot of Canadian companies come down, either just opening operations here and are looking for acquisition opportunities.
Yeah, the phone has been busy, and as the tariff conversations peek their head up and go back down, the phone calls adjust to that. But again, I think it always comes down to what is the right thing for your business long-term, with or without tariff changes, with or without interest rates, currency fluctuations, and really what is that true growth path for your business.
Yeah.
Those are the conversations we're having.
Yeah, and the impact of tariffs, I think that, hopefully we'll have a little bit more clarity later in the summer here in terms of what the president administration is doing with making deals with other countries. We had, as I mentioned earlier on, the first part of our webinar today is that we're going to try to do this update maybe 3 times a year. We're anticipating maybe doing something later this summer. And hopefully by then we'll have a little bit more clarity, because that does create uncertainty. There are our clients that are trying to maybe sell, and even buyers, from Canada or other, really just anywhere, are really nervous about the tariff impact. But again, we'll hopefully see some progress there. Yeah, obviously we've already signed one with Great Britain. Seems like we're making strides with China, which is one of the biggest impacts, and some other countries, and hopefully with Canada too. We're hoping that things will progress there. So more to come on that. Hopefully in our next update, we'll be able to provide some clarity. So the COVID, post-COVID impact, we want to stress there is that for a handful of years now, we talked to a lot of our clients that there's always been this worry about, okay, how is my business really profiting? And is it being caused by COVID, or are there some other factors? So I think we're finally getting to the point where it seems like we're in this post-COVID period where things are starting to normalize a bit. Where more clarity in terms of profitability and where companies are going. So in that, certainty creates more certainty with timing of when to go to market. And I think that's maybe one of the key points here. So in terms of deal volume, I know Pat talked a little bit about that at a macro level, but we are seeing a pretty healthy deal volume, not only buy side, but sell side. For many reasons, I think that Buffalo, like a lot of other places, do still have a baby boomer impact. There's a lot of baby boomers that are still looking for that exit strategy. During COVID, they kind of put that on hold potentially because of volatility. But Buffalo even more so because it is more of an aging population than other parts of the country. Plus, their families and kids have moved out of the area, so they may not be interested in coming back to run mom and dad's business. And so they're looking to exit. So we are seeing a pretty healthy deal volume in our market with our client base and some of the referrals we're getting. As Pat had mentioned, multiples starting to normalize. We are seeing that also seems to be the case in Buffalo with small and middle market type companies that we typically deal with. And then structuring, the point I wanted to bring here is that some of the uncertainties in the environment, the tariffs, other things, we're getting more creative, and our clients are getting more creative with trying to come up with a structure that can get the deal done and maybe mitigate the risk for buyers so that, again, we can get the deal done. Such things as rolling equity into the buyer is maybe being interested in earnouts or holding paper. I know those aren't really popular things with sellers, but I think if you want to have a healthy exit, you have to be open to different structured ideas. So the other thing that we're seeing, and I think this is broadly across the country too, but probably more so recently with employee stock ownership plans or ESOPs. Now, when I started my career in 1994, which is hard to believe it's been that long, but ESOPs were just starting to go out of vogue for some reason. We didn't see a lot of ESOPs, new ESOPs, for many, many years. And we're starting to see more and more of those discussions, especially in Buffalo. It seemed to be more prevalent that they're taking interest in how an employee stock ownership plan can solve their exit strategy. And I think some of that is related to, well, geez, my kids have left, as we talked about, my kids have left Buffalo. They're not interested in running my business. They get other maybe restrictions, or could be other reasons. So maybe I'll look to see if my employees are interested. And I probably had ESOP discussions more in the last year than I have in my entire career. So we are starting to see that as a trend here in Buffalo. Baby boomers, as we talked about, again, Buffalo is no stranger to baby boomers trying to exit. And again, being creative and flexible about how you may structure a deal to counteract what's going on in the current marketplace. And I just want to add one last thing that I've started to have a conversation with clients, especially in the service industry, the impact of AI, artificial intelligence, how that might impact their business, and really the need to embrace that. Find with business owners, typically even some of the clients that we deal with are still somewhat of an older generation still, and they're being able to conceptualize how AI can change their business fundamentally, really within probably the next 2 to 5 years, is something they're really going to need to embrace to, again, be able to capture that value, make sure that they're competitive. So if they do go to market to sell the business, that they're remaining competitive and profitable. So that AI impact is something I think still to be determined, but certainly keeping that in the forefront I think is important. So I think with that, I want to turn it to Josh.
Thanks, Mark. All right, so in this section of the webinar, what we're going to attempt to do is highlight some of the challenges that Mark, Pat, and I have seen on deals that we are currently working on, deals we've done in the past, and then also provide you with some strategies that you guys can use to avoid these challenges and pitfalls on deals that you're working on, whether it's a sell-side deal or a buy-side deal. We'll try to get a mix of both. So the first challenge, something that we run into frequently, is poor or infrequent communication. I'm sure as a lot of you know, buying and selling a business is no easy task. There's a lot of moving parts. There's a lot of individuals involved. You're going to have a lot of teams involved. You're going to have legal. You're going to have the due diligence team, accountants. You're going to have your internal team as well. So poor or infrequent communication can lead to confusion, delays, and missed opportunities. Something that we can do to fix those issues. So if we go to the strategies, first thing that we can do to fix poor or infrequent communication is to assign team members along with a respective focus area. So for larger businesses that may have like a corporate development team or a more robust internal team, you're going to have your outside legal counsel that you can bring into the deal to help you with the legal requests that will be going on. You're also going to have, if you're a larger business, you'll have an accounting department where you'll have some managers and some staff that you can bring into the team. And we'll talk about a little bit when the right time to bring those different individuals into the deal is. It's not something that is done right away, and there's a little bit of a line that you need to toe to figure out when that's the right time. But in terms of the macro deal level, poor and infrequent communication is lessened when everyone knows their role in the deal and allows them to have a task and things that they need to focus on to get done. So something we've found to be a problem is when there's really no assigned team members that have a specific role in the deal. You have multiple people working on different things. Sometimes you have duplicative work, which can also slow down a deal. So better communication and just making sure that everyone's on the same page is pretty key. Something we've also, another strategy for success here is to set a weekly check-in meeting, whether that's internal, if you're the business owner with your internal team, just to make sure everyone's on the same page, that to-do lists are getting done, request lists are getting fulfilled, but also between you and the seller, the buyer, your accountants, your legal team. And this can get cumbersome because there's a lot of different, like I said, parts that are involved here, but having a weekly check-in, us specifically on the accounting side, whether we're doing a sell side or a buy side, we're checking in with our clients at least once a week. And a lot of the times on these deals, we're only a phone call away, so we're checking in more frequently than that. Honestly, the more frequent communication you have, the better, and that will obviously lessen the poor and infrequent communication. So making sure everyone's set on the same page. You also want to set boundaries between management and then any third-party consultants that you have coming in as well. So you're going to have, there will be NDAs and information that certain parties will not be privy to. So you want to make sure that everyone, again, with better communication is on the same page and understanding that who has access to what. We're working on a deal where you may have a deal where you are buying, let's say, 4 companies out of a 6 company conglomerate, and the accounting function, the finances may be combined. So we're working a deal where you need to have certain structures in place to make sure that the information that needs to be where it needs to be, that there's no cross-pollination of information getting sent around that is not for certain teams' eyes. So the legal team may not need all the information that the finance team is getting to do a proper due diligence. So you want to make sure that you set those boundaries ahead of time so that everyone is aware of who's getting what information and there's no confusion or animosity between different teams if they receive something that they shouldn't, or are upset that they didn't receive something if it's not something that they necessarily need. And then also you want to discuss each step of the process and expectations prior to diving in. So we'll get into the steps in one of the later slides. But again, the real main thing here is more communication, the better. If you go a couple weeks or a couple days without talking to someone in your team about a deal that you're working on, something's wrong. You definitely want to be communicating throughout this process. It's a very robust process, so the more communication, the better. All right. And then another challenge that we've seen as well is inadequate resources and capacity issues. So you can see the bullets on the slide. There's inexperienced team members. That could be a problem. And this isn't necessarily a knock on any business owners who have employees. We all like to think that our employees know what they're doing and are good at their jobs. However, what we really mean here with this bullet is you may have an accounting function that you brought in that was just recently hired. We had a deal recently where our client had just hired an accounting manager. Now, when you're doing a quality of earnings report or due diligence, and you need to understand a lot of the historical impact of the financials, if you have a new accounting manager or a new CFO that was just hired that wasn't around during COVID or wasn't around during the prior periods, they may not have all those answers off the top of their head, and could be inexperienced as far as the dealings of the business. So this is an issue that we see. Also, overburdened employees, and this kind of goes along with the last bullet point, day jobs and special projects. You also have to think incentives here too. When we're doing sell-side engagements and also buy-side engagements, if it's a mom and pop shop or if it's a single owner, the owner is obviously very incentivized to sell. They're really the one at the end of the day that's getting the payout. It's usually financially beneficial to them. However, the employees, if it's a takeover or if one of our clients buying a business, the employees are not necessarily getting a payout, and they're going to have a new boss going forward. So, and sometimes these deals, the challenges that we can run into is the owners are very motivated to sell, and when there's a lot of request lists and things going on, they're on top of it. They're ready to get the information to us to get the deal done. You could run into a situation where you're funneling everything through an accounting manager who is not really incentivized in the deal, doesn't really have anything connecting them to the deal, and may put the request list to the side, put it under a stack of papers, and not get to it, or get to it when they can. Especially if they have a full-time day job, which we've experienced a lot as well. People are working 8-hour days, 10-hour days, doing their normal job. And then if you have a buy-side project or a sell-side project that you're going to try and fit in on top of that, you're going to run into issues with timing and different levels of priority between day jobs and special projects.
Yeah, I think Josh, one of the things that we see is that more and more is transaction bonuses being paid to key people.
Right.
To help them to stay engaged, because they do have a day job and that's probably work a little bit harder. And I think the other thing that we find is that this comes a little bit back to communication and developing expectations is sometimes the bankers and the ones that are executing the diligence don't have an appreciation for what it really takes to run a business day to day. And so their only task is to close the deal. Whereas the CFO or the controller or HR person internally, they have 10 million other things going on that also have deadlines. So I think that's that communication expectation side.
Yeah, I think again, it's just setting realistic expectations at the beginning of the project and kind of making sure everyone's aligned, because as you said, a lot of the smaller companies may only have a certain number of people within that function. So realistically, how much can they do on top of their day job? So just kind of setting that expectation at the front end is huge. So
right. So some strategies we have that we can hopefully fix some of these issues is you need to assess the internal capabilities and experience of your team prior to moving forward and making sure that you have the correct people in the right position. Again, if you have inexperienced staff or you need some help, you got to make sure that you have the ability to put people where they need to be to get these deals done. So if you're the owner, you may need to come into the business a little bit more and help out your CFO or your accounting team get all the financial diligence out the door, get the request list out. You may need to take a more bootstrapping approach to make sure that things are getting done. Also, workload management. Again, this kind of goes back to that your employees will have a full-time job to do on top of any buy-side requests or sell-side requests. So you need to assess the availability of personnel to adequately handle the requests. One thing that we've seen that has been successful for us is our firm here. We have a staff augmentation and consulting division. So something we can do, a service that we can provide to our clients is we can send out resources to clients to help pull together some of the information. This works really well for a lot of our clients who may not have a super large, robust accounting function. We were working on a deal recently where all of our information was coming from one individual at the company, and there was a lot of requests that could be done that could be pulled from a staff level or a senior level that can go in, be on site with the client, gather a bunch of information and get it out the door to keep the deal moving quickly. So staff augmentation is something that can work here that we've had success with in the past. And kind of along those same lines, permitting external access where appropriate as well. Specifically in our line of work with accounting, QuickBooks is a very common ERP or accounting system that a lot of our clients use. And there's a great functionality there where we can have an accountant's copy. It's called an accountant's copy. And that allows us to go in on our terms and pull in the reports that we need, specifically like AR agings or all the financial information that we need. This can take a lot of the stress off of an owner or an accounting team to get some of the base level Excel documents that we need and the financial data. We've also seen this actually work with payroll companies as well. A lot of payroll companies will have like a read-only access, third-party access that you can set up or a link that you can send to the parties that need it to go in and pull payroll reports or bonus information and different stuff that you'll need for the deal. So using staff augmentation coupled with some read-only access and external access to people who need it can help lessen inadequate resources and capacity issues. So the next challenge that we see, big milestones and deadlines. So again, it's kind of going to keep, some of these are going to keep going back to the more communication, the better. Mark and I, we always talk about it. It's all about setting expectations and making sure that everyone's on the same page. What kills deals is miscommunications and unaligned expectations. So hopefully with deals that you're working on, you have an LOI, you have legal documentation that's in place where some of these deadlines are set out. But if they're not, it goes back to, again, setting up a weekly check-in with your client, making sure that everyone's aligned on the milestones and the deadlines. So some of the strategies that we can use to lessen that is discussing detailed timelines with management. And this is like actually setting dates. We've been on calls with the clients before where everyone brings up their calendar. We're all staring at the same calendar. We're looking at dates. We're picking dates. We're saying, okay, this request list needs to be fulfilled by this Friday. And then a couple weeks after that, we have this deadline. So picking actual dates, making sure everyone's on the same page as far as a detailed timeline is very important. If you just start saying, and again, this kind of goes back to what Mark was saying with investment bankers and the pressure that they put on sometimes, is if you just start saying, oh, we'll get that to you as soon as possible. Well, as soon as possible, someone might be, in someone else's mind might be that night or the next day, but you might be thinking by the end of the week or by the end of the month. So just making sure that you have a detailed timelines with dates and times for things that you want to get done will just help lessen vague milestones. And then also the sell-side engagement. A traditional timeline that we've seen on these deals is anywhere, on a sell-side deal specifically, is anywhere from 6 to 12 months. And we kind of outline it here for you. There's 5 stages and each one could take 2 to 3 months to get done. So understanding these 5 stages and making sure that you are, again, communicating with everybody in these stages, you're going to see a lot of the times that some of the stages involve different types of people, different groups of people. So you're going to want to make sure that, again, that everyone's on the same page and that everyone's aware that sometimes these deals take longer than you can expect. We've had discussions in the past with clients who want to sell a business and they want to go to market and be closed in 6 weeks. And there's expectations that need to be set, again, just to make sure everyone's on the same page, that may or may not be possible. We've also seen a lot of times where they come in and they want to go to market right away, but we have to do 6 months of cleanup work first to make sure that the finances are in good order, bank accounts are reconciled, cash is good, accounts receivable is trending the right way. So again, just going back to setting expectations, making sure that everyone's aware about how long these deals take sometimes, and having deadlines and milestones set up along the way.
Yeah, I think this is a common conversation we have with clients, and what Josh is describing here is, when you think about getting ready to go to market, that's when that clock starts clicking. It's usually a 6 to 12 month, and our clients ask, well, why does it take so long? It's for all the things that Josh is describing, right? Just limited resources, constraints in terms of getting deals done, as well as dealing with vacations and holidays and summer and all sorts of factors that are uncontrollable.
Yeah, and one thing we see here, with, like you just said, Mark, with vacation and holidays, this last bullet, a lot of deals we've seen, we kind of see a pickup in work towards the end of the year. A lot of companies are trying to pick up on the end of the year, the pickups that businesses get, and then are also trying to close deals before the year starts, because January 1st is just a nice clean cutoff to to bring a new company into your portfolio. So we see a lot of deal volume happening towards the end of the year. But that's also when you have 3 months in a row, October, November, December, that all have holidays in them. You've got Thanksgiving break, you've got Christmas break specifically at the end of the year. So if you're trying to close a deal by the end of the year, you have to understand that you could lose 2, maybe sometimes 3 weeks to just Christmas vacation as well. So, and then you have November Thanksgiving as well. So understanding, again, this kind of goes back to, again, more communication, bringing up your calendars on calls, everyone walking through, making sure that you know when people are going to be out of office. If you're expecting to have a financial due diligence done by the end of December, but you lose the accounting team for 2 weeks, it's really going to put a strain on being able to get that done. All right, got a couple minutes left here. Challenge number 4, lack of centralized information. So again, better communication is always the right way. Specifically, also, this challenge is around documentation and making sure that the right parties are getting the right information. The worst thing you can do is start sending around information over email. We all know that we live in a digital age where phishing emails are common, and digital security is something that's top of mind for everybody. So in these deals, what we found is that having a VDR, a virtual data room set up, is the right way to go, and to make sure that everyone is getting what they need and that the documentation is in an organized place for everyone to be able to access it. So whether it's buy side or sell side, this goes for both. There's a ton of different VDRs out there. We picked one here at the firm that we like that works well for us. The point here really being is that you need to pick one. You need to pick something. We've seen clients use Google Drive, which isn't necessarily the best, because if we talk about some of the strategies to fix this issue, one of the things we see is that the second bullet here, setting a clear precedent regarding permissions and access and who can contribute, delete, and download. What we found with like a Google Drive or an unsecured data room is that it's too many hands in the cookie jar. So you've got, especially if you have all the different request lists all set up in the same data room, the legal, the HR, the benefits, the financial diligence, you could have multiple different members of each team going into the data room, uploading data, kind of sorting it. What you don't want to do is have everyone have the same permissions and be able to go in and shift things around, delete things, upload stuff that may or may not be necessary. Data rooms can get very jumbled very quickly. So another strategy for success, again, is this last bullet, forming a regimented request list, which you'll be sending out, whether it's buy side or sell side, to get the information that you need. What you want to do is align the VDR to be the same as the request list. This kind of goes without saying, but you'd be surprised how many times we run into this issue where we get a beautiful request list, or we send out a request list that has like all the things that we need, A1, A2, A3, and then you go to upload it into the VDR, because that's how you're going to get the information to where it needs to be. And all the folders are named something different. It's 1, 2, 3 instead of ABC. It can get very confusing very quickly. So one of the things that we do here at the firm when we have access to the VDRs is to make sure that it aligns with our request list to lessen that confusion and make sure that everyone's on the same page and that all the data gets where it needs to be. And again, also allowing certain access to certain folders. I don't necessarily need access to the HR folder or to the legal folder. If I have access to the financial folder, that's really all I need. And it'll keep mistakes from happening if you can control access to VDRs.
Yeah, I think the other thing that a VDR does help too is that, and attorneys will probably be in support of this, is it documents what information was provided. So if it's resident emails and other things that's not in the VDR, you can't prove if there's a dispute post-close. You can't prove that a certain document or information was provided to the counterparty. So VDR is a documentation of that.
Yeah, and then even speaking a little bit more to the VDR, is a lot of the functionality now with them is, to that last point there, forming a regimented request listing, is you can create an Excel template, and a lot of them are just easily uploaded there, and it automatically creates folders, so on and so forth. So I think the functionality has come a long way, and the other side of it is you may not have access to one, but if you talk to one of your advisors, they may already have some sort of account set up to where they can help get that set up for you. So just something to keep in mind that, you may not have to go do it personally, but leverage your team.
Yep.
Well,
Charlie, I think that's it. Do we have any questions?
Yeah, there's a bunch that have come in, so I'm gonna let you guys take a look at them while I run 2 more polls, just because I couldn't decide which one to do. I need to. So we gave you guys, a lot of information today, a lot to take away with you. So just kind of want to see where you're at with everything and how you're feeling. Just clean up my screens. So the question is, based on what you learned today, how are you feeling? So we'll see if people are feeling good, if people have work to do, if people are more confused than they were before. We'll see how that came in. I'll just give everybody a quick minute to put their information on. As our experts take a peek at the Q&A that came in. If you do have a question, feel free to pop it in. Just to kind of share with the group real quickly. The results were, looks like a little bit more than half the group is good and they're on track. And the other half of the group joined us today to learn. So that, and then I just have one other quick question for our audience today. As we plan out this series, like the guys talked about, what are those other questions that you have? What other experts would you like to hear from? So if you can put that in real quick, that'll help us build out the series for this year and even going into next year. So we have the topics that you want to know about.
Yeah, stay tuned for that because we want to bring in some other experts, some of which may be from the outside. So we're going to bring in some guest speakers and things that can speak to certain topics. And if there's something on here or something that's not on here that you're curious to learn more about, feel free to send Carol a message or put it in the chat. It would be super helpful to help us kind of shape future programs for the group here.
Great, I'm just going to close that out and just kind of share so other people can see potentially what's on the horizon. So some good response there. So, and then I am now going to move us to the Q&A section. And also put up contact information for all of our experts if you want to reach out to them directly. I do have QR codes too for our LinkedIn page and our YouTube page if you want to go back and see any other videos and recordings that we have done. So Mark, I think this question, you'll best be able to answer it. How can I apply the market data you presented to my own company? You want to take that one for us?
Yeah, so I think it's great question. I think my response would be is to be cautious of actually applying broader market data to your specific circumstance. I think we have to take that and say, okay, what are the general trends that can kind of help you plan sort of timing? But I think you have to look within your industry, do a little bit of a deeper dive and say, okay, what data is available for your specific industry that can say, are multiples up or down? And don't let, if there is a downturn in the market or volume is down, don't let that necessarily discourage you because things, again, could be different in your industry and they could also be different in your geography. We talked about Western New York, right? We were seeing, I've talked to a number of folks outside of Buffalo say, deal volume seems to be down this quarter, but we're not seeing that in Western New York right now. So don't let the market trend necessarily dictate, give you some guidance, but you got to do a little bit deeper dive in terms of your geography as well as your industry.
Great, thank you. Hopefully we answered that question for you, Tim. And Pat, I think one came in from Mary that you might be able to touch upon. Given confidentiality concerns in the deal process, how do you decide who to involve internally without creating unnecessarily alarms amongst employees? So that's always tricky. So
Yeah,
Josh, you might want to jump on this one too.
It is. I mean, I think it's very dependent on the size of the function that you have internally. So sometimes you are limited to where you're only going to have one or two key people that you're going to have to rely on. So you may be kind of limited on that unless the owner themselves kind of takes on all of the incoming requests and goes about it that way. If you're dealing with more of a larger function, I think that can vary quite a bit because you don't want to instill any sort of panic with the employees or anything that you do bring in. So trying to work it or navigate it is almost like a need to know type of basis. And then from there, leveraging the VDR to, again, set up your security controls, make sure that people only have access to what they need to have access to. and trying to navigate it that way. But it's always a difficult discussion and one that should be had at the beginning to make sure that we're including only necessary people.
Yeah, something I'll say here too is a lot of the times too, it can depend on what milestones and dates you have set. So for example, if you are expecting to have the financial diligence requests fulfilled in 4 weeks, maybe that's enough time for the CFO or the owner themselves to go in, get the information when they can and provide it to who it needs to get to. If you're expecting the due diligence requests to be fulfilled in a week, well, then you may need to bring in your accounting manager and a couple of staff accountants as well to grab the request list so everyone can work on a piece of it and provide the data quicker. So a lot of the times there's a push and pull in terms of how quickly do you want to get things done. That can also dictate how early in the process you bring people in. Now, eventually you're going to get to a point in the process which we see commonly where if the CFO starts poking around in certain folders or starts pulling certain reports, it may throw up some red flags to employees who may see that and say, oh, why are you pulling, why does the CFO care about this certain report that they don't usually pull? So it may be time to bring in people at that stage when you necessarily can't pull the data that you need. We also see a lot of times too, as a CFO or an owner, you may be at the 10,000 foot level and not necessarily know how to access or even have the information to get to some of the detailed information that's being requested. And at that point, again, you may have no other choice than to bring in your accounting manager to help you get the information that needs to get done. So there is a fine line, but again, it depends on timing and it depends on what information you're being asked to pull.
Yeah, it's definitely something that you want to take into consideration. You don't want mass chaos or panic amongst the staff that something's going on because you're either not including people, so then it seems secretive, that people then start to worry about. So we are right at 1 o'clock, so I do want to end it on time for everybody today. If we didn't get to your question, we will respond to you directly and follow up with you. If you have additional questions, again, you can reach out to any of our experts at any time. We thank you for joining us today. Again, please fill out that exit survey that will be sent to you. And again, this afternoon, I will send you an email with the recorded session and a copy of the presentation. So everybody knows we are right now, we'll be continuing this conversation again in August and November with our part 2, part 3 updates. And then other topics that we have coming up for June is state and local tax compliance. If you need help with that or have questions or don't even know what that means, join us in June for that. And then also for anybody that's on here today that is the nonprofit world, we will be talking nonprofits also in June. So we hope to see you then. Have a great one, and thanks for joining us today.